Namaste folks, hope you all are doing well. I'm Karan Bandal from Econosite, and in this video let's talk about the trillion-dollar problem with the US national debt. The headline is that the United States may have to pay over $1 trillion in just the interest on its debt starting as early as 2026. Now, is that bad? Well, let's investigate. Let me interrupt here for a quick update. America's gross interest payment has already breached $1 trillion mark in 2023. What we are talking about in this video is the net interest amount. That is, the net interest on US debt is expected to hit $1 trillion mark by 2026. The difference between gross interest and net interest is that gross interest is simply the interest on US debt. US debt is sitting at roughly $33 trillion with an average interest rate of 3%, which gives us the gross interest payment of around $1 trillion. Net interest is gross interest amount, that is $1 trillion right now, minus any income that the US government makes on its own assets. For example, US might earn interest on certain loans and investments that it has made. This amount gets subtracted from the gross interest payment, which brings down the net interest that US has to pay on its debt. Therefore, the net interest amount on the US debt has not yet reached $1 trillion mark. Okay, back to our analysis part. If you go back about 2 decades, the top 3 expenses in the US federal annual budget used to be Social Security, Medicare, and Defense. Interest on debt was relatively benign then. But 2024 onwards, interest on the national debt will be the 3rd biggest expense. Defense will be pushed down to number 4. Here's a bird's eye view of the US national budget for last year, that is 2023, when defense was still the 3rd biggest expense. The US brought in a little under $4.5 trillion in tax revenues and other receipts and spent a little over $6 trillion on the national priorities. That puts the country's fiscal deficit at around $1.5 trillion. Fiscal deficit is the gap between a government's income and its expenses, which the government must borrow from the market. Now look at some of the top expenses. We can draw a few key insights. First, interest expense featured in the top 4 biggest expenses. Second, if you add up the top 5 expenses, they make up around 3/4 of the total US spending. And third, if you add up Social Security, Medicare, and Medicaid, which are also known as entitlement programs or social welfare programs, they make up almost half of the US spending. So if somebody wants to reduce the US spending, there is no option but to review these programs, in my opinion. Because very soon, interest on the US debt is going to act like another expensive entitlement program that will have to be dealt with. How did the US get to a point where the interest expense has become a point of discussion? See, the US borrowing and debt was already on its way up in the aftermath of the global financial crisis of 08-09, as the US Fed had lowered interest rates to 0, which made it easier for the US government to borrow and spend to stimulate growth. As the economy slowly recovered in the following years, the Fed started lifting rates in 2016. Because money is not free and interest rates cannot remain zero bound forever. A few years later came another shock to the economy. The COVID pandemic hit the world in late 2019. US Fed then sent rates to 0 again. US borrowing surged like never before to deal with the COVID related shutdown of the economy. The surge in borrowing is visible in the Treasury issuance since 2020. This is how the US government borrows money from the market, by issuing treasury bonds. In fact, 2023 saw a record $23 trillion in bond issuance by the US Treasury Department. The result is that the US national debt now stands at over $33 trillion, or roughly 120% of the US GDP. The issue of a record high debt gets compounded by another factor. This time around, the nature of stimulus spending by the US government included sending money directly to American households. That, combined with COVID-led supply chain squeeze, caused US inflation to spike beginning in April of 2021. And it peaked at above 9% 14 months later. To deal with this onslaught of inflation, the US Fed began raising interest rates quite late actually, but in the end the Fed did raise rates aggressively and to levels not seen since 2001. The end result is a substantial increase in the average interest rate on the entire US national debt. Now do the math. An all-time high national debt plus an elevated average interest rate on that debt equals an interest expense that raises quite a few eyebrows. We know when talking about national spending, debt, taxes, etc., ratios matter more than absolute numbers. So through that lens also, interest expense stands out. This year, America is expected to spend $870 billion or 3.1% of its GDP on interest payment, nearly double the annual average of 1.6% since 2000. The interest portion as a share of the GDP is only expected to go up in the decade to come. In absolute numbers, you can see how the net interest expense may hit $1 trillion in 2026, keeps rising every year following that, and cross even $1.5 trillion mark in just about a decade. So back to the question, is a $1 trillion interest expense bad? Maybe not just yet, because in 2023 the interest expense was still manageable at about 15% of the total income of the US government. Nobody really thinks that the US will miss a debt payment. Treasuries in fact form the foundation of the global financial system and the dollar is the world's reserve currency. A strong network effect is at play here. Having said that, a $1 trillion interest expense may pull the US into a vicious cycle of increasing debt. Here's how. Investors now assume that the US will run permanently larger deficits than it has in the past, eventually putting pressure on the economy and financial markets. See, to fund large deficits, the US will have to issue an increasing quantum of treasuries. Investors or buyers of these treasuries may demand a higher return to compensate for the risk and uncertainty. Ultimately, higher borrowing costs on mortgages or home loans and corporate loans would slow the economy as consumer spending and business investment weaken. That means the government's tax revenue goes down, requiring them to borrow even more to meet their commitments. In summary, the interest expense on the US national debt is rising. The interest can still be serviced quite comfortably, but in the years to come, more and more of the US national budget may go towards debt servicing. That will lead to underinvestment in the productive areas of the economy, compromising its long-term prospects. A well-calibrated combination of cutting expenses and raising taxes may be needed to address this problem of rising interest expense. I hope you found this analysis interesting. I'll speak with you again next week. Until then, take care.